The Golden Standard Podcast, brought to you by WeSellSilverAndGold.com. Connect with us online to buy gold and silver at cost, or start your own journey into gold and silver as a business and wealth generator by calling Brian at 682-238-1557. All right, welcome to our deep dive. Today we're taking a look at gold.
Yeah.
We've got some really interesting stuff to unpack from you. You've brought us some NED-TV profits, some Bridgewater Associates, some of the latest from IPEX Empire.
Right.
All about what's really going on with gold right now, what's driving it, and what we might be able to look forward to.
Yeah. I think this is a super exciting time for gold.
Uh-huh.
I've been following it for a while, and just the amount of confluence of things happening right now all seem to be pointing in the same direction.
Yeah, absolutely. And we've already seen some, huge moves. Gold's been up. It's touched, 3,000 an ounce recently.
Yeah.
So let's start there. Like, what is driving this rally? What have we seen recently?
Well, one of the biggest things that we've seen is, especially at the beginning of this rally, last year and the year before, was central bank buying.
Oh, yeah.
It was really the primary driver. Central banks around the world, after the Ukraine situation and the freezing of Russian reserves, kind of woke up and went, maybe we should have something else other than U.S. dollars in our reserves.
Yeah.
Particularly countries that maybe don't have perfectly aligned interest with the U.S.
Right. Yeah, that's a pretty big event. It's, some people are saying it's kind of like the U.S. closing the Bretton Woods window back in the 70s, signaling a move away from that dollar-gold connection.
Exactly. It's a very similar sort of geopolitical de-risking event,
yeah,
where countries are realizing that, holding foreign exchange reserves might not be the safest thing in the world, especially if you're not, best friends with the issuer of that currency.
And this is leading to some pretty, bold predictions about where gold could go. Some of the experts that we've seen and heard from are talking about, 4,000 by the end of the year, 5,000 next year, maybe even 6,000 before the end of the decade.
Yeah.
Those are certainly optimistic projections.
Yeah.
But, based on, simple trend extrapolation and the continuation of these sort of fundamental drivers, it's certainly not impossible.
And one of the interesting things about this rally, though, is that, usually we would see ETF holdings move in tandem with the price.
Right.
When gold goes up, people buy ETFs. But in this case, that hasn't really happened. ETF tonnage is still below the 2020 peak, even though the gold price is up like 50% since then.
It's really interesting. This is not the typical ETF-driven rally that we've seen in the past. And that really underscores that central banks are really the ones who are behind this.
And it makes you wonder, if they're reporting all of their buying. There's some speculation out there that, looking at import-export data, that maybe central banks are buying even more than they're letting on.
Yeah, stealth gold buying.
Yeah, exactly.
So gold has these really interesting long cycles, right? Like, you look back, the 70s was a bull market, 2000 to 2012 was a bull market.
Right.
Both saw some huge, price increases. And the argument is that, with these tailwinds that we're seeing, the central bank buying, the geopolitical uncertainty, this could be, the start of another one of those major cycles.
And I think that's certainly a possibility. And if that's the case, even the optimistic projections that we talked about could be too conservative.
Okay, so we've kind of established the why, right? Like, central banks are buying, geopolitics are driving a lot of this. But let's talk about gold itself. Like, what makes gold so appealing as an asset, especially in times like these?
Well, gold has certain fundamental properties that make it unique. And this is something that Bridgewater talked about. First of all, it's not a liability. Gold is a thing.
Right.
Right. It's intrinsically valuable.
Yeah.
Unlike a bond, which is a promise to pay, or a stock, which is, the value of a company's future earnings, gold is just gold.
Right.
The supply is limited by the process of mining it.
Yeah.
And it's very transferable. It's very liquid. It's easy to move around the world and to buy and sell. And I think these properties are becoming increasingly important in the current global climate.
Yeah. So it gives you a sense of security, right? Like, you know that you have access to that wealth, that savings. It's not going to go to zero. But what do you give up, by holding gold instead of something else?
Well, what you give up is the potential risk premium that you get from holding liabilities, right? So bonds and stocks, they pay interest. They have the potential for capital appreciation.
Right.
Gold typically doesn't do either of those things.
Okay.
So you're not going to get an interest payment from holding gold. You're not going to, see the price of gold, go up tenfold because, the company that you own stock in, had a great quarter.
Right.
Gold is more of a storehold of wealth than it is a return generator.
Okay. And Bridgewater talked about how, that storehold of wealth aspect became even more important after Ukraine. Why is that?
Yeah. Well, I think before Ukraine, we kind of took for granted that you could always access, your fiat currency holdings, right?
Yeah.
If you had dollars in a bank, you could always go get those dollars.
Right.
But I think the sanctions on Russia showed that that's not necessarily true, depending on the geopolitical situation.
Right.
If you hold a fiat currency that is issued by a country that you're not aligned with, there's a chance that you might not be able to access those holdings.
Yeah, that makes a lot of sense.
And so that really, really highlighted the storehold of wealth function of gold.
And this has kind of disrupted this historical relationship between gold and real yields, hasn't it?
Yeah, traditionally there's been a very tight correlation between gold and real yields. When real yields go up, gold goes down and vice versa. But, starting in 2022, we saw that relationship decouple.
Okay.
And I think that's because the demand for gold as a dollar alternative became so strong that it just overwhelmed that traditional relationship.
Yeah, and we saw this, divergence in buying behavior.
Right.
Like the East was buying more, the West was buying less.
Yeah, exactly.
Yeah.
And I think that really speaks to this idea of gold as a globally diversified asset. It's not tied to any one country. It's not, the pet project of any one central bank.
Right.
It's a truly global asset.
All right. So let's bring it a little bit more up to date. We've seen this rally continue in 2025. Gold's up, around 10% this year. Even with tariffs, we've seen reports of physical shortages. We've seen gold being repatriated to the U.S. So what's going on now?
One of the things that Bridgewater pointed out, which I thought was really interesting, was that tariffs could actually be a bullish pressure on gold.
Oh, okay.
And it might seem counterintuitive, because, tariffs create inflation.
Right.
And typically central banks would respond to inflation by raising real interest rates.
Yeah.
Which would make gold less attractive.
Right.
But the thing about tariff-driven inflation is that, it's a one-off source of inflation.
Okay.
Right? It's not some sort of underlying, inflationary spiral.
Right.
It's just, this one-time increase in the cost of imported goods.
Yeah.
And so central banks might be less inclined to really aggressively raise rates in response to that. And that could lead to a situation where, the dollar's going down, but real rates aren't necessarily going up that much.
Got it. So it kind of gets that best of both worlds scenario for gold bugs, where you get the inflation, but you don't get the rate hikes.
Exactly. And then on top of that, tariffs create uncertainty.
Right.
Right. They create uncertainty about trade policy, about international relations.
Yeah.
And that's also bullish for gold.
Yeah, absolutely. And they also talked about some interesting technical market dynamics as well, about how these tariffs could actually be leading to importers locking in gold prices ahead of time.
Yeah. So the thinking is that, if you're an importer and you're expecting, tariffs to be imposed, you might go long COMEX gold futures.
Okay.
As a way of locking in a price.
Right.
And so that increased demand for futures contracts could create a situation where, the future price is higher than the spot price plus, the cost of carry. And that creates an arbitrage opportunity.
Okay.
Right. So billion banks, commercial banks can come in, they can buy physical gold, they can ship it to New York and they can deliver it against those futures contracts.
Right.
And they can make a profit on the difference. And so, indirectly, tariffs could be leading to physical gold flowing into COMEX vaults.
That's really interesting. And we've also seen some headlines, about the revaluation of the Treasury's gold, about the Fort Knox audits. What do we make of that?
Well, Bridgewater's view on the Treasury gold revaluation is that it's mostly an accounting change.
Okay.
The Treasury values its gold at like $42 an ounce.
Yeah.
Which is obviously ridiculous. But marking it to market wouldn't really have any direct impact on market prices unless it somehow triggered buying or selling.
Okay.
They talked about the possibility of repo. The Treasury, doing repos against its gold, but as far as we know, that's not happening. And then on the Fort Knox audits, I think the standard practice in gold custody is to not give out a lot of information.
Yeah.
For security reasons, for privacy reasons, and so, I don't think there's any real evidence, to suggest that there's any gold missing or that it's impure.
Right.
It's just, that's the way that gold custody works.
Okay. So, those are some interesting headlines, but they're not really, fundamental drivers of what's going on in the gold market.
Right.
So let's talk about gold in a portfolio. If you're an investor, how should you be thinking about incorporating gold into your overall asset allocation?
Well, Bridgewater suggests that a strategic allocation to gold of around 10%, has historically been a good idea.
Okay.
Because gold tends to have a negative correlation with financial assets. It's around negative 30%. And so, it's a good diversifier. The main benefit of holding gold is not necessarily that it's going to outperform cash.
Right.
But it's going to give you that diversification benefit.
Yeah.
And it's going to tend to perform well, when other things are doing poorly.
Yeah. And that's really key, right? That it kind of moves in the opposite direction. So when you're, seeing your stock portfolio go down or your bond portfolio go down, gold can kind of act as a hedge.
Exactly. Yeah. It tends to do well in environments of rising inflation, falling growth.
Yeah.
Which are, typically the environments where traditional assets are struggling.
Right.
But, the challenge is that, the market often focuses on returns.
Right.
Rather than diversification benefits.
Yeah. So for our listeners who are, maybe interested in getting some exposure to gold, what are the different ways that they can do that?
Yeah. So, we talked about a few different ways to play the gold market.
Yeah.
You can own physical gold.
Right.
You can trade futures.
Yeah.
You can invest in gold mining companies.
Okay.
Which, offer some additional, value beyond just the gold exposure.
Right.
They're also levered to the price of gold, but they also have, their own operational, leverage.
Right.
And management.
So it sounds like, the big picture here is pretty bullish. We've got tariffs, we've got, high levels of debt in the developed world, we've got this, changing global order. But are there any, bearish pressures out there? Anything that we should be worried about?
Yeah. Well, Bridgewater did mention, a couple of potential, bearish pressures. One is the possibility of increased fiscal discipline in the West, particularly in the U.S. If the U.S. government, were to really get serious about reducing the deficit, that could lead to lower gold prices.
Okay.
But the likelihood of that happening, is debatable.
Right.
And then the other thing is that, a lot of these bullish drivers are now, pretty well known.
Right.
Right. And so, to the extent that they're already priced in, by speculative players,
yeah.
Maybe there's not, as much, upside potential, as there was, a year or two ago.
Right. So the potential for a surprise is maybe a little bit lower.
Yeah.
But the long-term picture still seems, pretty good, right? Yeah. Because there's just, not that much new gold coming onto the market every year.
Right.
Relative to the size of these balance sheets.
Right. The gold market, it moves in these really big long-term, price shifts, because, the throughput of metal is so low, relative to the balance sheets of the major players.
Right.
And so, I think the near term support, for gold is likely to continue. But, the future is always uncertain.
So as of March 24, 2025, we're recording this. Where do things stand right now?
Well, FX Empire, says that gold is kind of range bound right now.
Okay.
After a little bit of a pullback, it's trading around 3027.49.
All right.
And the market is kind of waiting to see, what happens with the PCE inflation data.
Yeah.
Which is coming out soon.
Okay.
And also any, further developments on the tariff front.
Right.
Those are kind of the two catalysts that could really move the market.
It seems like the dollar weakness is providing a little bit of support right now.
Right. Yeah. Short term, the weaker dollar is definitely helping gold.
Okay. Are there any key levels that we should be watching, from a technical perspective?
Yeah. So, from a technical standpoint, we've got, resistance at the recent high of 3057.59.
Yep.
Near term support, around 2968.92.
Got it.
And then the really key support level is the 50-day moving average, which is currently at 274.97.
Okay.
As long as gold stays above that level,
Mm-hmm.
I think that the bullish bias is intact.
Okay.
Near-term targets, maybe 3100, 3150.
All right. Sounds good.
Yeah.
Well, this has been a really great deep dive. I feel like we've covered a lot of ground here.
Right.
We've seen, how central banks are playing a role, geopolitics, even tariffs. It's really interesting how all of these things are coming together to drive gold higher.
Right. And I think the takeaway here is that gold is not just a commodity.
Right.
It's a vital portfolio diversifier.
Uh-huh.
Especially in times like these.
Absolutely. So it makes you wonder, given all of this, given the potential for, more volatility, more uncertainty, how does gold fit into, your understanding of wealth preservation and growth?
Right.
It's a fascinating landscape. It's one that we're going to continue to follow closely.
Yeah, absolutely.
The Golden Standard Podcast, brought to you by WeSellSilverAndGold.com. Connect with us online to buy gold and silver at cost or start your own journey into gold and silver as a business and wealth generator by calling Brian at 682-238-1557. Thanks for joining us.
Yeah, thanks for having me.